Hello, if you're new here, my name is Tatiana Trades. Basically a beginner trader. I've been on a 7 month long trading journey, and I've been back testing every day for 8 to 12 hours, basically. Um, you know, 7 months into my trading journey, which is basically last month, I had basically studied my ass off for 7 months, but my win rate was staying at 30 to 40%, and I was trying to get a 60 to 70% win rate or higher, but I couldn't figure out why I wasn't able to get that 70% while other traders were. And I ended up joining this trading Discord and talking to a few successful traders about how they look at price. And this one particular person said something to me that made everything click. And I was instantly able to make a 70% win rate. Now, a disclaimer, just because this person said this to me doesn't mean that I would have, like, for example, if they had said this to me a few months back, that doesn't mean I would have instantly been able to make that 70%. The reason why I was able to make that instant jump from 35 to 40% to 70% is that I already had months and months of knowledge from back testing. And my issue wasn't a skill related issue, nor was it a knowledge issue, but more so how I was thinking about the market. And once I understood how to look at the market with this one sentence, I was instantly able to get that 70% win rate. Now, I'm going to show you guys my current understanding of the market, and in the hopes that this will help you fast track your trading journey. Now, one sentence changed my trading forever. Literally 2 days ago. And I was able to get a 70% win rate instantly. Now, what was that sentence? And you probably, I think this one guy in my comment section said, "What is your secret?" It's really not a secret. This is something that's been known in the trading community for a very long time. But I feel like for some people it might take a little bit longer to understand this. And I'm going to try and bridge that gap and help you guys better understand how to go about looking at the market every single day when you come to the charts. Now, that sentence is, everything is a market maker model. Now, this is one of the core concepts of ICT trading. And you're probably wondering, if you're not familiar, what is a market maker model? Because I know that is not the first time you've heard this term or concept. Well, a market maker model it's three things. It's three different types of trading setups in the market. So these are setups, meaning they are high probability areas in the market where price is likely to do something, aka reverse from, basically. And reversals are the most high probability areas in the market to get good runs, good price runs, basically. You can usually get 1 to 2, 1 to 3 R pretty easily, I want to say. So there's three different types of market maker models. The first one is external range of liquidity to internal range. Oh, actually, this is a mistake. Hold on. Hold on. I mixed these up. This is external range liquidity to internal range liquidity, and this one is internal range liquidity to external range liquidity. Sorry about that. Let's get back into it. So, internal range liquidity to external range liquidity. Now, what is internal range liquidity? Let's just define that first. Internal range liquidity, how I look at it, is a fair value gap. Some people define internal range liquidity as being inside a range, but I'm just going to completely simplify it for you. Internal range liquidity is a fair value gap. I don't care what anyone says. We're going to define internal range liquidity as a fair value gap, okay? It's nothing else. It's just a fair value gap. So, external range liquidity. How do we define external range liquidity? External range liquidity is our old low or old high in the market. So we want to trade from internal range liquidity to external range liquidity. And price is always bouncing back and forth between the two. Price will always go from external range liquidity to internal range liquidity, from internal range liquidity to external range liquidity, from an old high to an old low. Market is always balancing back and forth between these ideas, these concepts, basically. So this example this is an actual chart example. So this was on the M30, so on the 30-minute chart, this is an M30 fair value gap, and once you get your swing point, you can target the other end of that range here. So internal to external, and as you can see, we moved away from it with a lot of force. These are high probability areas in the market the price is likely to turn away from, aka reverse from, and then you can target external range liquidity. Realistically speaking, if you had gotten here, you wouldn't even need all of this. You'd get 3R probably somewhere around here within the range. I would recommend just going for 2 to 3R. You could hold for the whole range, but you're just being greedy at that point. We just need 2 to 3R, okay? That's all we need every single day in the market. We don't need any more than that. Now, the next one is external range liquidity to internal range liquidity. And as I said, that is defined as an old low in the market or old high. In this case, this is an old low. So as you can see, price taps into it. We get a reversal. This is a reversal candle here. And then we go back to internal range. Do you see how many candles are working this fair value gap? This is internal range liquidity. So that is that example. Pretty straightforward. Then we have range low to range high. And as I defined before, it's basically just an old high to an old low, right? Or old low to an old high. This is a perfect example because we do both. We go from old high, sorry. We have a swing point and then we go to an old low. Then we create another swing point, then we go from an old low back to an old high. And as you can see, we have a lot of willingness. These candles are big and long, and you can see that there's momentum behind these moves. So that is basically the 3 models or concepts of basically the market maker models. Once I understood this, and I already did know this technically, but I think it's more so, I think what really made it stick to me is the fact that this is at the forefront of how I look at the market now. Before, my mind was really clouded. I had a lot of concepts battling each other for importance. But now when I think and look at the market, these concepts right here are at the top of the pyramid, basically. This is what I'm looking for. So what is the whole idea? The whole idea is price engages a key level. I'm going to say that again. Price engages a key level being a fair value gap, which would be classified as internal range liquidity, a old high or low, which is classified as external range liquidity. Then we create a swing point out of these levels, and this is where the fractal model comes in, because the fractal model, I previously thought that the fractal model was, well, a model, but it's not really a model. It's just identifying a swing point. That's all it is. The fractal model is just allowing you to identify a swing point, because price cannot reverse without a swing point. So those fractal models are the swing points that tells us, it's a signature on price that tells us that, oh, price is likely reversing here. And once we have that, then we can drop down to a lower time frame and enter. So I think that's one of the biggest difference. I used to kind of have the fractal model at the forefront of my trading strategy, and I do use fractal models, but the overarching idea is not the fractal model, it's the market maker models. This is where your focus should primarily be. The fractal model is more of an entry model, okay? The fractal model is just an entry model. That should not be your primary focus. It should be the market maker models and being able to determine where price is likely going to go from day to day. And by that, I mean, where is the daily candle likely to expand to, right? So this market maker models and daily bias is at the forefront of what you should be looking at. And then the fractal model is just identifying where price is going to reverse, aka a swing point. And then we drop down to a lower time frame and then we enter, okay? So this is basically my current understanding of trading in my head. To be honest, this is kind of the same thing. I think this I think you just need to focus on this. I'm going to go over this, but this is basically as simple as it gets. This is all you need. This is everything you need. You do not need anything else. Just think about the market like this, and you will be golden. You will be on your way to a 70% win rate, okay? So how I understand trading in my head currently. So one, you want to determine your daily bias and long-term direction. So you want to align your weekly and daily, and you want to figure out where the daily candle or the weekly candle is likely to expand to. Then you want to align your time frame, time frame slash framework plus phases of price. So what do I mean by this? Because that was a lot of words. So you want to align your time frames, meaning, okay, once we go on the weekly, we determine, okay, the weekly candle is likely to expand upwards, so it's likely to be a bullish candle. I'm like, okay, cool. So, but then we need to see, okay, is the daily candle also expanding, right? And then you go on the daily and you're like, okay, yeah, the daily is expanding. Then we go on the 4 hour, and then we see an open high low close of the 4 hour for that daily candle. We're like, okay, the 4 hour is also expanding. And then we drop down to maybe like a 30-minute or a 1 hour, and then we find, okay, so I know that the price is likely to go up today. Now I need a model. If it's going to go up, what is the easiest way to get on side? Internal to external. Wait for price to pull back into a fair value gap and then trade it upwards, right? Because we know price is going to go up. So it makes sense to get on side with that by trading from a fair value gap where we know price is most likely to reverse from, right? It's that simple. Enter on the low time frame that aligns with the higher time frame model. So for example, if we go back to this one, this is an M30 example. So this is where we identify our model, internal to external, right? So once we identify our swing point, which is basically this candle here, then what time frame aligns with the 30-minute? The time frame that aligns with the 30-minute is the 3-minute. So for example, I'm not sure what 100. Okay, so I know 4 hour is aligned with the 50-minute. 1 hour is aligned with the 5 minutes, 30-minute is aligned with the 3-minute, the 50-minute, you can align it with the 1 minute or 3-minute, and so on and so forth, right? You can also do this if you want to do long-term trading. I'm not sure what aligns with the daily again. It's either I think it's the 1 hour. So basically, if you find a daily model, then you can enter on the 1 hour once you have your swing point, and then so on and so forth. So yeah, that's basically it. So the next thing is, how do you apply this every day when you get on the charts? Simple framework. And this is basically what I just explained. You're going to go to your weekly, your day, then your daily, your 4 hour, your 1 hour, then your 5. Sorry, this, you can actually mess around with this. You can go from 4 hours to 30-minute and then 3-minute. You can go from 4 hours to 50-minute, then 1 minute, or 50-minute to 3-minute. There's a lot of ways you can do this. But timing is very important. So once you get your swing point slash fractal model, you want to instantly jump down, and you can enter via a fair value gap, a small fair value gap, order block, or a CISD, right? And there's still a few more caveats you need to be aware of, but that's the big picture. And I do have a list here. I didn't put them here because I just feel like it's going to overcomplicate things, and I just don't think you need to overcomplicate it right now, because everything I told you is how you need to think about the market. And once you understand that, I feel like everything else will be easier. So, but I'm going to read off this list here that I have that talks about a few caveats. So you don't want to trade away from equal highs or lows, okay? Do not trade away from equal highs or lows. That's one. Be aware of phases of price. Phases of price is price can move 4 different ways. Price can expand, price can retrace, price can consolidate, and price can reverse. So when price comes back into a fair value gap, we are identifying the first part of that is going to be, so obviously when prices come back into a fair value gap, that's a retracement. And then the fractal model is going to be the swing point reversal, right? So that's going to be a reversal. And then we want to trade the expansion, right? The whole idea of market maker model is to trade the expansion away from the reversal. Those are the most high probability setups in the market, right? So, and then this is a little bit more specific to futures, although it does work in Forex as well. Driver logic. So drivers are just times of day where the market gets flooded with liquidity. So that'll be your 8:30 news. That'll be your 9:30 equities open, 10 o'clock news. Basically anything that pushes liquidity into the market. So this is for that. So driver logic. If the retracement or reversal has already happened prior to the driver, prior to news, basically, the driver, the news, or price should just expand. But that's a more complicated concept. I'm going to put you guys onto some resources in a second. Just give me a second. And, obviously think about everything as a market maker model. And that is basically it. So additional learning sources are going to be GXT, T-Trades, and they have videos on universal sequences. Now, we're going to jump over to that real quick together. Just give me 1 second. So we're going to jump over to YouTube. And we're going to go to GXT. And you're going to go to his channel. And you're going to go to the GXT universal sequence. And then this will basically cover everything I talked about, but he will cover it way more depth than I do. So he's going to talk about internal to external, external to internal, and then he'll talk about the swing points that I talked about, so fractal models, and then he'll also talk about, I believe, how to enter these the swing points. I think he does. Right? I think he just talks about the overall market maker models. They call them universal sequences, but they're basically market maker models, okay? And then he also puts it all together and shows you how to enter as well, okay? So this is basically your full comprehensive video on everything I just discussed in my video. He goes way more in depth, gives you examples, and it's an hour-long video, so this should help you. If you guys have any questions, leave them down below. Don't forget to like and subscribe. And I'll see you in the next one. I hope this helped. So, with that being said, peace.